Hello there and welcome to an Elliott Waves Theory series that we want to present here. How to use binary options trading with this wonderful theory. For those of you that don't know what Elliott Waves stands for, Elliott comes from the name of Ralph Elliott, and the overall theory is built on the beliefs of this man that the market or financial markets or any particular financial product moves in waves. Or if a market travels from, let me take a trend line from here, travels from here to here, it won't do that in a straight line, but it would do that in different moves, so-called waves. Namely, you have moves to the upside, moves to the downside, or the main trend move, then a counter trend move, then a main trend move and a counter trend move, and that's the Elliott Wave Theory. The Elliott Waves Theory in principle is very simple, but its simplicity makes it so complex that very few people truly know how to use it. I'm not saying this just for the sake of saying it. I'm saying this because I trade with Elliott Waves Theory as my main trading tool, and after all these years it still has amazing features to be discovered. Now if you look at the basics of the theory, we have the following simple concept. If you open any book related to the subject, you will have 1, 2, 3, 4, 5, namely 5 waves up, 1, 2, 3, 4, 5, corrected with 3 waves down, A, B, C. That's the Elliott Wave Theory. So what's so difficult, or what's so difficult to understand on this sequence? Well, exactly, it is very simple, but its simplicity makes it quite a complex structure. The thing is that in dividing the waves, the way it did, Elliott divided the moves in 2 different parts. In an impulsive way, this move to the upside, this is an impulsive wave, and in a corrective wave, or this move that comes from here to here. Therefore, an Elliott Wave Cycle, this is called an Elliott Wave Cycle, by the way, this one here, this is being called an Elliott Wave Cycle, and a cycle has an impulsive move and a corrective wave. An impulsive move, this bullish move, and a corrective wave. Now the same is valid on a bearish move. You may have, if you have a bearish trend, you will have an impulsive move to the downside, or a 5 waves trend, 5 waves to the downside, corrected with or followed by a counter trend's move to the upside, A, B, C. So 5 waves up, corrected with 3 waves down. That's the Elliott Wave Cycle. So what's so difficult with it? Well, the problem is that Elliott found that the market makes cycles within cycles and within cycles. What does it mean? It means that this is only one cycle, part of a cycle of a bigger degree. So if you label this one as the first wave up, followed by a second wave, and then you look for the third wave, then this first wave is formed out of waves of a lower degree. 1, 2, 3, 4, 5, corrected with A, B, C, and so on. In this case, what we have here is an impulsive wave on the left side and a corrective wave on the right side. The next video that we'll make here will deal with the rules of an impulsive wave, what an impulsive wave makes, and we'll look for some examples on the market. What's important here to note is that any impulsive wave is labeled with numbers, so 1, 2, 3, 4, 5, like this, and it is followed by a corrective wave, an A, B, C. As a rule of thumb, Elliott doesn't work without Fibonacci. So if you want to know something before starting trading with the Elliott Waves Theory, is to know how to integrate the Fibonacci retracements and Fibonacci expansions into an Elliott Wave Cycle and an Elliott Wave Count. As mentioned earlier, the key to any Elliott Waves success is to integrate this cycle. This is a cycle, but it is a cycle of 1 degree. You may end up having various degrees. Elliott found a super cycle, a cycle, then a minuet and sub-minuet and so on. What I'm trying to say is that of a lower degree, you'll end up having a 5-way structure for the first swing higher. 1, 2, 3, 4, 5. Corrected by what? By a 3-way structure. A, B, C, or a corrective wave. This is still an Elliott Wave cycle, only that it's a cycle of a lower degree. The next move up, you know by now, it is a 5-way structure. 1, 2, 3, 4, 5. Surprise, surprise. Corrected by what? Corrected by A, B, C. This is still a cycle of an Elliott Wave cycle, but of a different degree. Namely, at the end, by the time that we label this one 1, 2, 3, 4, 5, we just labeled one wave of an even bigger degree, and that will be part of a wave of a bigger degree, and so on and so forth. What's the catch with the Elliott Waves theory? Why do traders love it? Various reasons come to attract traders to this Elliott Wave theory. First of all, it is the only theory that allows to incorporate both price and time in an analysis. It's one thing to know where price will go, and it's a totally different thing to know when price will do that. But surprise, in binary options trading, this is what we want, to know the direction of the market, where the market will go, where the price will go, and then to know the period of time or the amount of time taken for the price to go there. Ideally, because at the expiration, all we want is for price to be, or for the option to expire in the money. Stay tuned for the second part, and on the second part we will deal with the rules of an impulsive wave, and we'll tackle a bit some examples here to see how to use an impulsive wave and how to trade binary options with an impulsive wave, because it is quite interesting. Stay tuned, please.